After studying this module, you shall be able to, number one, know about the importance of tax issues in international business. Number two, learn about the interplay between the tax issues in international taxation. Number three, identify the important issues for international business in the area of taxation. Number four, evaluate the impact of tax issues in making decisions regarding international business. Number five, identify the ways to deal with the key tax issues in international business. Rationale for understanding tax issues in international business. International business is the carrying of business activities across the national boundaries through various routes, or as we refer to them, through various modes of entry, namely trade, direct, indirect and intra-corporate exports. Number two, contractual mode like licensing, franchising, management contracts and turnkey projects. Number three, foreign direct investments in say greenfield investment or brownfield investment with alliances or without alliances. The significant factors that are considered to choose a particular mode at the time of entry and even at the time of planning to shift from one mode to another are given below. Number one, ownership and control. Number two, corporate capability. Number three, business environment. Number four, location. All these factors along with a number of other factors are analyzed in order to come to a conclusion regarding the selection of a particular mode of entry. It also helps to achieve the full potential by resolving the issues related to the international business. It is very important to understand the legal environment in which the business will be carried out or is being carried out. We need to analyze a component of the legal environment called the tax laws. It will help us to deal with the tax issues arising out of the complex nature of tax laws. This will result in appropriate compliance of these laws, which is necessary for the smooth running of the business. In this module, we will try to list and understand some of the important tax matters and issues in international business. We will try to develop an insight into the impact of these issues on the business. We will further look at the ways of tackling these issues to reduce their adverse impact and enjoy the benefits provided by them. We shall now throw some light on the key tax issues in international business. In the present, global economy is reeling with huge uncertainty due to sluggish growth, increased competition and complex tax regimes. Business houses are focusing on the issues related to the tax systems throughout the world, such as transfer pricing matters, uncertainty over the taxation of various transactions and levying of multiple indirect taxes in order to build up a successful business model. It can provide good returns to the existing stakeholders and also attract prospective investors. We have divided the chapter into two major sections. Number one, key tax issues in international business, and number two, ways of dealing with the tax issues. The key tax issues which need to be understood for the purpose of planning and carrying out the activities which form a part of international business to achieve the preset objectives are listed below. Number one, transfer pricing. Number two, double taxation. Number three, multiple levies of indirect taxes. Number four, miscellaneous issues in taxation. The above stated issues have been discussed in the sections which follow. Number one is transfer pricing. The increasing share of MNCs in the economic activity across the world has given rise to new and complex issues arising from the transactions entered into by two or more enterprises belonging to the same multinational group. These MNCs manipulate the prices charged and paid in such intra-group transactions. It is to control the profits derived by such enterprises carrying on business in different tax regimes. This results in erosion of tax revenues of the revenue authorities and thereby increases the overall profits of the group as a whole. Example: an enterprise in India sells goods or provides services to an associated enterprise in Ireland for rupees 1 lakh. The fair market value of such goods or services is rupees 2 lakhs. The tax rate is 30% in India and 10% in Ireland. This manipulation of prices reduces the income of Indian enterprise by rupees 1 lakh as the fair market value is not charged, which is rupees 2 lakhs. It also reduces the cost of the associated Irish enterprise by rupees 1 lakh, which eventually increases the profit of the Irish enterprise by rupees 1 lakh. Income of the Irish enterprise remaining the same, a reduction in cost will inflate the profits by difference in the fair market value and the actual price charged. This results in profit shifting of rupees 1 lakh from India to Ireland, where the tax rate is lower by 20%, and hence the tax outflow on the shifted profit will be rupees 10,000 instead of 30,000. This decreases the tax outflow by rupees 20,000, which increases the profits after tax of the group by rupees 20,000. Associated enterprise in relation to another enterprise means an enterprise A which participates directly or indirectly or through one or more intermediaries in the management or control or capital of other enterprise, or B in respect of which one or more persons who participate directly or indirectly or through one or more intermediaries in its management or control or capital are the same persons who participate directly or indirectly or through one or more intermediaries in the management or control or capital of the other enterprise. According to many surveys conducted by reputed institutions, transfer pricing, also called TP, issues have been one of the most important and contentious issues faced by multinational corporations, in short known as MNCs, and governments all over the world. India too has seen a sharp increase in the number of disputes related to transfer pricing. The tax authorities are adopting an aggressive stand in arriving at arm's length price for the related party transactions in their way to bridge the fiscal deficit and prevent a rating downgrade by rating agencies. This is very much evident in the form of transfer pricing adjustments in India crossing INR 70,000 crores, around $12 billion. In the initial period after the introduction of TP regulations, fundamental issues which arose were: number one, selection of time period, which means single versus multiple year data for comparability analysis. Number two, choosing the appropriate transfer pricing methodology. Number three, applying the plus minus 5% range on the price charged in relation to the arm's length price calculated to decide whether any adjustment is required or not. Number four, application of filters for selecting comparables and other procedural matters. Today, most of these issues are nearing settlement through rulings of appellate bodies and courts, and a few through amendments in the regulations itself, and newer and more complex challenges are emerging. We will try to highlight some of the emerging issues which are significant in the TP area for carrying on international business. Issue of shares by an entity to its associated enterprise, AE. When a foreign entity plans to subscribe to the shares of a domestic entity, it has to be careful in the valuation of shares so that the price at which it subscribes to the shares is consistent with the policies of the government of the country in which the domestic entity is located, and the valuation procedure complies with the ALP principle so as to avoid any dispute with the government. It also has to keep in mind whether the issue of shares is considered as a capital receipt not subject to capital gains tax, or is considered as sale of capital asset or a financing transaction chargeable to income tax, which will bring about a change in the stance of the government while it is scrutinizing the transaction. For example, the Indian government has made adjustment of INR 152 billion and INR 13 billion in case of Shell and Vodafone respectively for the undervaluation of shares as per their norms. Hence, to avoid such disputes, it is imperative for the entities to do a fair valuation, which should be supported by a robust justification and a comprehensive documentation. Financial transactions. Companies within the same group charge different rates of interest depending on the tax regime in which they are located to reduce the overall tax payment by the group and increase their group profits. Various governments are making adjustments in the interest rates charged by companies from other companies within the same group by referring to the country's prime lending rate, also known as PLR, rather than to international reference rates used by the companies such as LIBOR. Companies within the same group have to keep in mind the reference rate used by the respective government for judging the fairness of payments made by one company to the other within the same group while entering into financial transactions such as loans, guarantees, etc. It should not give an appearance that the companies are involved in base erosion and profit shifting by charging excessive interest for the loans and guarantees such as compared to the market rate of interest or charges for the similar transaction according to ALP principle, the principle of arm's length pricing. Now we come to royalty payment. It is very important to establish whether a particular transaction involves sale or transfer of license, because in case of sale payment received is considered to be business income, whereas the same payment is considered to be royalty income when the license is transferred, which will define the extent of taxability of this said transaction. For example, transfer of copyright involves payment of royalty, whereas transfer of copyrighted article is a sale resulting in business income, and business income is taxable in some countries only if the enterprise selling the copyrighted article has a permanent establishment in the country where sale is made, whereas royalty is always taxable subject to a 10% withholding rate when PAN of the receiver is available and a 20% withholding rate when PAN of the receiver is not available. Companies can avoid disputes relating to royalty payments by an AE by paying attention on the following areas. Number 1, proving the need for sourcing such intellectual property. Number 2, proof of actual receipt. Number 3, appropriate documentation evaluating and describing such intellectual property. Number 4, fulfillment of the benefit test by the receiving entity and its quantification. Number 5, appropriateness of the quantum of royalty payment. We can deal with the above issues by deciding the quantum of payments on the basis of market price and maintain proper records, or be ready to face tax disputes leading to huge adjustments. Management fees or corporate fees payment. Management fees or corporate fees have certain areas to be focused on to avoid disputes resulting in disallowing of such payments as business expenditures. It leads to higher income and higher tax for the receiver company and the normal tax for the head office, thus resulting in double taxation of the same amount. Key areas to be focused on are: number 1, nature of payment; number 2, actual delivery of services; number 3, need for such services; number 4, benefit derived; and number 5, basis of pricing. Thus, the payment of management fees should be justified and evidenced by quality and thorough documentation, so that it is not looked upon by the tax authorities as a device of profit extraction to avoid taxes. Same reason and cautions apply in case of sourcing of finished goods and inputs to or from the AE situated in some other country. Thus, TP is a major area of concern for entities like MNCs involved in international business. It will affect their future planning, as it leads to double taxation of the same amount both in the hands of the payer and the receiver company within the same group. Let us understand what is this double taxation. Double taxation is the levying of tax by 2 or more jurisdictions on the same declared income in the case of income tax, asset in the case of capital taxes, or financial transaction in the case of sales taxes. Many countries formulate double taxation treaties to mitigate this double liability. The term double taxation is additionally used, particularly in the USA, to refer to the fact that corporate profits are taxed and the shareholders of the corporation are usually subject to personal taxation when they receive dividends or distribution of those profits. Talking about relief from being taxed on the same income twice, individuals, corporations, and other concerns such as partnerships, pension funds, trusts, etc. can apply for relief at source and claims to repayment of tax. The types of income covered by the double taxation treaties fall into 2 main categories. Number 1, interest, pensions, royalties and purchase annuities, and number 2, dividends from companies. Now let us understand treaty shopping. The instrument of tax treaties was developed to deal with the problem of double taxation and attract foreign capital required for increasing the pace of economic growth. An important problem has arisen from the very concept of tax treaties. Instead of solving a tax problem, they are misused in the form of large-scale treaty shopping. Article 22 of the 2006 US Model Treaty, an anti-treaty shopping provision, provides a meaningful explanation in this regard. Within quote, residents of third countries benefiting from what is intended to be a reciprocal agreement between 2 countries, quote closed, it is a practice of structuring the business of a multinational group in which a business entity, that is a resident of a country which has not entered into a tax treaty with the source country where the income is generated, establishes an entity or routes the flow of FDI through another country that has a favorable tax treaty to minimize the tax and thereby increase the overall return on equity. Use of tax havens. Another area in the realm of international taxation are the tax havens. The Organization for Economic Cooperation and Development, also known as OECD, identifies 3 key areas in considering whether a jurisdiction is a tax haven or not. Number 1, nil or only nominal taxes. Tax havens impose nil or only nominal taxes generally or in special circumstances and provide themselves as a destination to be used by non-residents to avoid high taxes in their country of residence. Number 2, protection of personal financial information. Tax havens have laws under which businesses and individuals can benefit from strict rules and other protections against scrutiny by foreign tax authorities. Number 3, lack of transparency. A lack of transparency in the operation of legislative, legal or administrative provisions is another factor used to identify tax havens. Corporations, in order to achieve effective tax avoidance, use multiple types of tax havens. Three types of tax havens form a Dutch sandwich. Number one, primary tax havens, the location where financial capital winds up. Subsidiary shell companies located there have obtained rights to collect profits from corporate intellectual property, also known as IP, by transfers from the parent. Number two, semi-tax havens, locations that produce goods for sale primarily outside of their territorial boundaries and have flexible regulations to encourage job growth, such as free trade zones, territorial only taxation, and similar inducements. Number three, conduit tax havens, locations where income from sales primarily made outside their boundaries is collected and then distributed. Large multinational corporations may have dozens of such tax haven entities interacting with each other. Multiple levies of indirect taxes. The current system is riddled with multiplicity of taxes at the center and state levels and the cascading impact of indirect taxes. Businesses need to do a situation analysis both for the present and the future on the basis of existing indirect tax norms and the prospective tax norms to decide about the quality and quantity of inputs to be used to achieve the present target for cost by sourcing local inputs and thus saving on customs and octroi, if they are too high to offset the advantage provided by low cost inputs from abroad. And number two, mode of international business in case of high customs, duty, contractual mode or the investment mode, also known as tariff jumping FDI, is appropriate as the burden of custom duties can be avoided to bring down the final cost borne by the final customer in the market, whereas in case of low or negligible customs duty, trade mode can be opted for depending on its cost reduction ability in comparison to the contractual or investment mode. The complete knowledge of indirect tax rules is also required to claim input tax credit as per rules of the countries which depend on the point of taxation norm and origin rules. Other tax considerations in international business. There are various other issues which need to be focused on by all the entities involved in the international business, such as rate of income tax, corporate tax, dividend distribution tax, VAT, service tax, excise, other local taxes. Number two, tax holidays for setting up units in specified areas. Number three, treaty overrides. Number four, residency rules. Number five, cost of compliance and procedural issues. Number six, effectiveness of tax dispute settlement mechanism. Number seven, tax laws for repatriation of profits. Number eight, clarity on foreign exchange issues. Number nine, level of complexity of tax laws. We shall now discuss the methods of dealing with the tax issues arising in the international business. First is the arm's length price, also known as ALP in short. It is the instrument used by the revenue authorities throughout the world on the basis of various model conventions adopted to tackle with the problem of transfer pricing, wherein an international transaction or specified domestic transaction, two or more associated enterprises enter into a mutual agreement or arrangement for the allocation or apportionment of or any contribution to any cost or expense incurred or to be incurred in connection with a benefit, service or facility provided or to be provided to any one or more of such enterprises. The cost or expense allocated or apportioned to, or as the case may be, contributed by any such enterprise shall be determined having regard to the arm's length price ALP of such benefit, service or facility as the case may be. Similarly, any allowance for an expenditure or interest or allocation of any cost or expense or any income in relation to the specified domestic transaction shall be computed having regard to the arm's length price, ALP, a price which is applied or proposed to be applied in a transaction between persons other than associated enterprises in uncontrolled condition. ALP is calculated by using the most appropriate method out of various methods, namely comparable uncontrolled price method, resale price method, cost plus method, profit split method, transaction net margin method, and such other method as may be prescribed. The following example will help in understanding the concept in a better way. For example, if an enterprise in India sells goods or provides services to an associated enterprise in the United States for rupees 10 lakhs and the ALP for that transaction works out to be rupees 30 lakhs, then the income of the enterprise will be calculated by taking the selling price at rupees 30 lakhs instead of rupees 10 lakhs, which will increase the profit or reduce the losses of the Indian enterprise by rupees 20 lakhs, and tax will be levied in India on this income and not as shown by the Indian enterprise. However, two important issues which arise in the application of ALP are: number one, selection of the appropriate method to calculate ALP, and number two, availability of the required information to calculate ALP. Entities facing the risk posed by TP have to take certain steps to mitigate TP problems, such as: number one, formulation of a proper pricing policy before or along the time of entering into the transaction rather than doing a post-mortem at the year end. Number two, maintaining a contemporaneous and comprehensive documentation evidencing the facts of a transaction. Number three, detailed economic analysis. Number four, justification of the underlying commercial rationale for the transaction. Number five, exploring the utilizing the tool of advanced pricing agreements, APA, to bring certainty and avoid double taxation. Now let's come to tax treaties. Meaning and scope. The primary objective of tax treaties is to remove and minimize tax barriers to international economic activity. Tax treaties prevent and minimize double taxation and tax evasion by distribution of taxing rights between the host country where the income arises and the home country where the beneficiary of the income resides. In practice, many countries have already adopted unilateral measures to prevent double taxation, such as a tax credit or exemption for income that has already been taxed abroad. Where such unilateral measures exist, tax treaties merely confirm these. Another important issue under tax treaties is tax-sparing credit. Tax-sparing credit is a special form of double taxation relief in tax treaties between a developed and a developing country. A business entity resident in a developed country is provided tax incentive by the developing country on the income generated in the developing country in the form of lower rates of taxes, tax holidays, etc. The developed country provides credit to the business entity of the amount of tax which would have been paid by the business entity in the developing country in the absence of tax incentives, or in other words, credit is provided by the developed country of the amount of tax paid by the developing country. Tax-sparing credit is a measure to encourage flow of FDI from the developed to the developing countries. India and double taxation treaties. India has signed double taxation avoidance agreements, in short DTAA, with 88 countries, including UK, United Kingdom, USA, United States of America, Thailand, and Germany, out of which treaties with 85 countries have entered into force. This means that there are agreed rates of tax and jurisdiction on specified types of income arising in a country to a tax resident of another country. Under the Income Tax Act 1961 of India, there are two provisions, Section 90 and Section 91, which provide relief to taxpayers to save them from double taxation. Out of them, Section 90 is for taxpayers who have paid the tax to a country with which India has signed DTAA, that is double taxation avoidance agreements, while Section 91 provides relief to taxpayers who have paid tax to a country with which India has not signed a DTAA. Thus, India gives relief to any taxpayer irrespective of the country he pays the tax to. A large number of foreign institutional investors who trade on the Indian stock markets operate from Mauritius or Singapore. According to the tax treaty between India and Mauritius, capital gains arising from a sale of shares are taxable in the country of residence of the shareholder and not in the country of residence of the company whose shares have been sold. Therefore, a company resident in Mauritius selling shares of an Indian company will not pay tax in India. Methods to avoid double taxation. Let us understand these methods. In general, there are three ways to avoid double taxation. Number one, exempting foreign income from domestic taxation. Number two, granting a credit for foreign taxes. And number three, deduction method. General anti-avoidance rule GAAR and specific anti-avoidance rule SAAR. General anti-avoidance rule GAAR we are starting with now. It is a concept which generally empowers the revenue authorities in a country to deny the tax benefits of transactions or arrangements which do not have any commercial substance or consideration other than achieving the tax benefit. Denial of tax benefits by the revenue authorities in different countries, often by disregarding the form of the transaction, has been a matter of conflict between the revenue authorities and the taxpayers. However, different countries have taken different approaches in this regard. Australia was in the forefront of introducing GAAR as early as 1981. Mature economies like Canada, New Zealand, Germany, France and South Africa have also introduced GAAR. Emerging economies have also started introducing GAAR with the phenomenal growth of their economies. However, some of the leading nations like USA and UK have taken a cautious approach. It is common for taxpayers to arrange their affairs in a way that will give them tax benefits, which are through genuine and legitimate actions. Over the past few years, it has been noticed that the revenue authorities have attempted to deny tax benefits, whether under the tax treaty or domestic law, by disregarding the form and looking through the transactions. However, genuine transactions consummated in a tax efficient manner need to be distinguished from sham transactions or colorable devices used for evading tax. The approach of revenue authorities has resulted in protracted litigation and uncertainty. The revenue authorities' attempts in this regard have not succeeded in most cases, especially in the Supreme Court, the most recent being in the Vodafone case. In India, there are specific anti-avoidance provisions in the domestic tax laws as well as limitation of benefits clauses in some tax treaties. Under the GAAR provisions, an arrangement including a step in or a part shall be considered to be an impermissible tax avoidance arrangement if it is undertaken within the main purpose of obtaining a tax benefit, and it, number one, creates rights or obligations which would not be created if the transaction was implemented at arm's length, or number two, results in directly or indirectly in the misuse of the provisions of the code, or number 3, lacks commercial substance in whole or in part, or number 4, is entered into or carried out by means or manner in which would not be normally adopted for bona fide purposes. Now we come to specific anti-avoidance rule. SAAR is a set of rules which target specific known arrangements of tax avoidance. They specifically lay down the conditions or situations where they may be invoked. These cater to arrangements that Parliament has envisaged as representing arrangements which may already have happened or which could potentially happen for tax avoidance. Treaty override. Under the Vienna Convention, international agreements are to be interpreted in good faith in case any international agreement treaty leads to unintended consequences like tax evasion or flow of benefits to unintended person. It is open to the signatory to take corrective steps to prevent abuse of the treaty. Such corrective steps are consistent with the obligations under the Vienna Convention. Further, the OECD commentary on Article 1 of the Model Tax Convention also clarifies that a general anti-abuse provision in the domestic law in the nature of substance over form rule or economic substance rule is not in conflict with the treaty. The general anti-abuse rule will override the provisions of the tax treaty. Thus, all the entities which are already involved in international business or are planning to step in the business activities across the national boundaries should have complete knowledge of the GAR and SAR. In order to understand the implications of GAR and SAR on their existing and planned business activities, they should use the safeguarding provisions in the law to prevent themselves from the tax disputes with the revenue authorities, which generally result into unplanned outflow in the form of higher taxes, erosion of tax benefits, penalties and other charges. Each country has its own set of GAR and SAR provisions, and thus MNCs need to adapt to the provisions of the countries in which their operations are based to avoid uncertainty in cash flows and profitability of operations. When not tackled properly, may upset the projections and forecasts and hence may become a repelling force for the existing and prospective investors of the entity. All the international operations should be planned and executed in a manner so that the benefit of tax treaties can be reaped by setting up the structure of the organization, operations and activities in a manner that imparts a character to them, so that they do not qualify as an impermissible tax avoidance arrangement. The MNC should also resort to authority for advance ruling AAR with proposed transactions to obtain certainty from a GAR perspective. MNC should also see whether GAR has prospective or retrospective application, and if there is any threshold limit under GAR laws of various countries which can be exploited. We shall now recapitulate what we have learned so far. Thus, from the previous discussion, it is very much evident that tax issues in international business cannot be ignored, and it is a significant part of the legal environment which needs continuous attention of the two stakeholders, that is the business entities and the revenue authorities under the various governments. The following points were highlighted by looking at the issues in taxation, that there are certain key issues in taxation which need to be understood to smoothly carry on international business. The international business entities should plan their operations keeping into consideration the impact of existing tax laws. Forecasting of the change in tax norms in the near future should also be done, which should form a part of the impact analysis on the business operations. Attention should be paid to the rising importance of transfer pricing rules. Knowledge of the applicability of tax treaties is required to avoid double taxation. Business entities should be aware of the situations in which the tax treaties are set aside by the GAR. Analysis of the indirect taxes on the overall cost will help to arrive at decisions leading to low-priced products and services. Robust documentation is the answer to most of the issues arising out of taxation in international business and also results in due compliance of the tax norms.